All right, greetings. Um, we are now back from our short break. This is part two of the 2025 June exam uh, preparation for 2026. So we are using last year's paper to prepare you for the June exam for 2026. Like I said before, you guys, this is just a guide. I am going to teach you methods, strategies on how to tackle, your June exams. And like I said, don't want people to cram, but you must follow each and everything that I do in order for you to be able to master any transaction that you come across. Right. So, what I'll just add at the end, right? We'll just add at the end after each and every activity. We mark. You see that what is it that gives you mark in the exam, né? And we're not just writing for writing. We are given information in the question paper. The question paper, when we the information is there, it's not like theoretical stuff, like business studies where you have to know what is the business function or the micro environment, right? What is in the environment, macro environment, and so forth. I'm not sure if those are the topics, but it's not like that. Here, you are given information. You must use the information to be able to answer. That's the fun part of about accounting. You do not have to memorize a lot of words, right? So, right here it was out of 5 marks, so you get 1 mark for each question, and then so we write the total here, right? And then we calculate everything afterwards. So in this case, obviously you would have gotten 5 out of 5, but I'm just showing you um, how how teachers mark. And then here, obviously, right, to mark for each entry, for each column that was entered. And obviously here liabilities was not affected, so they wouldn't mark that. So in any case, you must put a zero to show that there was no effect, but there's no mark allocated for that, right? So it happens like that for each and other questions that are there, that you see that you have written an amount, but then that amount is not marked, right? It's because of we follow the marking guideline, what to mark, what not to mark. Uh, and also, if there's calculations, you guys must put, you see, so that you do not lose marks. So in this case, here it's just the table, right? You must just fill in this. The calculations, you can do them on the side, but you won't lose marks for how can I say, isn't it? You get marks for calculations, but in this case, they just want you to fill in the table, right? So without you uh, having calculations here, it's okay. In this case, it's okay. But in other questions, you need to have the calculations there. Right. So let's just continue from where we left off last time without wasting time. Right. So here is the question. So I just went and did a copy, so which is why I typexed everything out there in order for me to get like a clean copy for you guys, and so you can work, so you can print it out on your own and work on it and make your own notes on it, right? It's not that what I've written here was incorrect, it's just that I needed you to get like a clean copy. Okay, right, so transaction B, okay? Usually transactions go by the dates, but in this case, they've written A, B, C up until G. So because of the rows here, do you understand? Okay, so in this case, the dates are not important. Can you see? The dates are not important. They just want you to know, to find out if you know your debits, if you know what is the account that is debited, what is the account credited, and what amount are you supposed to put in on your accounting equation. Okay, right. So transaction B says Majola invested a fixed deposit of 10,000 with Nedbank. Hmm? So I guess Majola is the owner and we are the business. And so we have invested a fixed deposit of 10,000 with Nedbank. Okay. Okay, so in my analysis, when I'm reading here, remember, two accounts must be affected in this case, right? Remember the one that I've written last? So I'm just going to underline from that. This was for A, and now we're doing it for B, right? Okay, so I'm just going to slightly show this transaction up here. So I need to have two accounts that would be affected. My first account, what would it be? In my first account, what would it be when they're speaking of Majola invested in a fixed deposit? Okay. Um, the word invested means 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 you took out money. You took out money to make money, correct? So so since you took out money, invested a fixed deposit of 10,000, this is the amount with Nedbank, right? You know for a fact that when you invest, you need to have money, and the money that you're going to invest, you are putting it somewhere, right? So here's your bank account. Bank is classified as an asset, increases on the debit, decreases on the credit. You have your 10,000 on the credit side. Why? Because you took out money in order to make money, right? So in this case, we have made a credit entry, right? So which means when we make a credit entry, the next step for us to do is to make a debit entry. Remember, we do not know yet what is the second account. We do not know what is the second account, what is its classification. But as soon as we find out what was the money for, why did we take out money in our bank, then we can be able to know what this account is, and then we classify it. So what was the money for? Invested a fixed deposit. Can you see? Invested a fixed deposit, right, of 10,000. So which means the money was for a fixed deposit. So there we go. Now a fixed deposit is an asset, right? Increases on debit just like bank, and decreases on the credit. So this is what was credited and this is what was debited. So when you go to so from my working out, when you go to question 1.2, the analysis, you start off with the account that was debited. From the two, the account that was debited was fixed deposit. So you start with fixed deposit. Then the account credited is bank. We're going to write bank. And then the amount that under asset would be how much? Let's look here. Right. Something interesting is going on here. It's because of the accounts, right? Remember I said what? I said to you that bank is an asset. Bank is classified as an asset, right? So whenever money comes in, your assets will increase. When money goes out, your assets will decrease under bank. So in this case, my uh, my 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 bank account was affected negatively, which means my asset will be a negative 10,000. That's what I will write. Okay, negative 10,000. But this interesting fact is that there's no income or an expense in this case. Remember, an expense is just simply something that it costs you. It hurts the business for you to spend on it, but you need to spend on it because you need for the business to function, right? Depending on whatever business that you're in, stationery needs to be there. Your pen, your pencil, your calculators, or whatever the business might be. I'm just making an example. And then your incomes would be the one that you receive money from. Do you understand? So in this case, we said that it is and the transaction said it's a fixed deposit. And remember, you took out money from your bank account, you are investing it, right? An investment is something that it's an asset. Do you understand? It's your money is still kept safe. You still have that portion of money that you took out, but you're gonna acquire it at a later stage when your investment matures. Do you understand? So, which is why we are saying fixed deposit is an asset, and it's the same as your bank. So you just moved your money from one place to another place for safekeeping. But in this case, you are getting an interest out of it each and every month. But we are not focused on the interest here. The transaction just simply told us that you took out money into a fixed deposit. That's it. So that's what you need to focus on. You don't need to now think of interest and stuff like that, how many months and so forth. Right? Simple, straightforward, like that. Right? So which means my owner's equity is not going to be affected because there's no income on expense in my transaction and liabilities. But now what happens to the plus? Because assets was affected negatively by bank, we see the negative. Assets was also affected positively by the fixed deposit. We need to see the positive 10,000 there. Can you see? And then you get your 2 marks for that transaction. You get a 1 mark, a 1 mark. Great. Right, let's move on. Right, now transaction C. In our transaction C now, we see that bought goods on credit from Bantu stores for 12,000 less 10% trade discount. Okay? Right? The keywords we need to figure out here to look at is that we bought, right? Usually when we buy when we buy on in cash, with cash, sorry, money goes out from our bank. But in this case, did we buy on cash? No. It says on credit. If you have a highlighter, you must make sure that you differentiate between your cash purchases and your credit purchases, because those are two different accounts affected entirely. You understand? So you need to know where's your starting foot in this transaction. So our starting foot is that we bought, but we never bought on cash, we bought on credit. Okay? Now, we as a business bought on credit. You understand? There's a journal for that. It's called the CJ. But in this case, they didn't ask for us to record our our journals. But we know that bought on credit, it's CJ. If someone buys from us on credit, the opposite of CJ is DJ. But in this case, they didn't ask for us for the journals, that's just an add-on. And then it says from Bantu stores. So this is our supplier. Can you see? For 12,000 less 10% trade discount. So which means now for 12,000, right? But they gave us a trade discount of 10%. Now let's calculate that. Right. So if you're given less 10% trade discount, you'll simply subtract 10% from the 10% of 12,000 from 12,000. But to do this much quicker, you'll say 12,000 multiplied by 90 divided by 100, and then you get your amount. Okay, here's my calculator. I'm going to show you. Okay, so 90 divided by 100, right? So which means the goods were actually taken to the business for 10,800. Can you see? Okay, let's go to the table there for our analysis of transactions. Okay, when we get to our analysis of transaction, we need to record the amount of 10,000 under the accounting equation, not the 12,000, because we bought on credit from Bantu stores for 12,000 less. So we need to write each and every information that you're given. You mustn't ignore. The information is given for you to use. So less 10% rate discount. Do you understand? So this is the amount I must record. This is the amount after the discount. You can just simply say 12,000 times 10%. It will give you an amount, and then you take 12,000 minus 10%, and then you'll get to this. So I just did it in a much quicker way. Okay. Right. So the second part, remember, two accounts are affected. We do not forget that. Right now we're just figuring out the amount that we need to do, to have. Right. So first account. What is the account that we need to have on top? It is not bank, because cash was not involved. And as I told you, right, if someone buys from us on credit, they are a debtor to us. If we buy to someone on credit, they are our creditors. So we have an obligation to pay them on a later stage. Right? We have an obligation to pay. So here you say what? You start off with creditors control. This guy is a liability. It's classified as a liability. Right? It's classified as a liability. Increases on the credit side and decreases on the debit side. Remember the date click. We said what? We said assets. We said expenses, assets, and drawings increase on the debit side, and liabilities, income, and capital, they increase on the credit side. So whatever entry that I have to start to make on this guy, it must be on the credit side, and not because of that. It's just because of we took these goods on credit, and our creditors in our books, we need to increase the liabilities. We cannot decrease the liability. We need to increase the liability, because we have now taken from someone. We now need to have to know that we have a liability that we need to pay. We cannot just say it is a minus. It doesn't make sense, because now we never paid for that. When we pay now, we will make an entry on the minus. But now, since this guy we owe, we need to, at the back of our head, we know that we need to pay them, but in the record it's a plus. We need to record here. Do you understand? So that 10,800 there, it is recorded there, right? So we've made a credit entry in this case. Can you see? So now we need to make a debit entry. We do not know the second account, but the second account needs to have a debit entry. Now we need to know, why did we make the credit, or what was the money for? Bought goods on credit from Bantu stores for 12,000. Without going far with this, can you see? We bought goods on credit. This is why we took credit. So usually goods are what? Trading stock. Trading stock is an asset, classified as an asset, increases on the debit side. Can you see? All right. So if sometimes it's difficult for you to classify an account, just ask yourself: is this a valuable position of the business? Yes or no? Am I getting money in the business? So it's not an income. Do you understand? Is it an expense where expenses like water and electricity, things that you buy and then they finish within a year? It's like those things that you have to constantly pay each and every time, right? You must notice in the household. You must always buy Wi-Fi. I mean, you must always buy data for the Wi-Fi. Subscription for the TV. Um, groceries. Those are expenses. Water and electricity, uh, gas, fuel. Those are expenses, right? But things like trading stock, it's something that when you have, it's valuable because you are going to generate money from that on a later stage. You are going to, when you sell it, you are going to get money on it. Do you understand? So which is why it is an asset. Okay, fine. So this is my double entry. Can you see? So now we can quickly go to our table here. So see, we have what as a debit from the two? We have trading stock. So account debit, account debit is trading stock. Account credit is what? It's creditors control. Okay, right. Now under my assets, what account affected my asset? Was it creditors control? Did we say creditors control is an asset? No, creditors control is a liability. But what was the effect? It was a positive. So there's liabilities, just simply put a plus and 10,800 there. Right, let's come back. The second account is not an income nor an expense, so which means it's a zero under owner's equity. The account was an asset, so we'll see a positive 10,800 there. Simple stuff, right? You get a mark for that, and that. See? Okay. Let's continue. Right. Account debit, account credit for D. Right. But this one now, remember I said to you, a transaction affects two accounts. Was right. So I just wanted to start you off with feeling comfortable with the fact that it's always two accounts, right? But with that also you do not be discouraged because now when you find out that there's more accounts affected maybe in a transaction, then you're like, ooh, now it's getting very tricky and very difficult. But okay, I'll just try to explain it to the best of my ability, and I hope you guys do understand this type of transaction. Right. Okay. So now we're gonna move from two transactions, two accounts affected to four accounts affected. But we're gonna start with the basic two account. So what we can see and we can grasp from the story that they are telling us, right? Because with this one, there's like a backstory that is going on, right? It's not as simple as exchanging. I want this. You can take it for credit and stuff like that, just like the previous example, just like the previous transaction. With this one, there's the first side of it, and then there's a back story behind it and what goes on internally in the business. All right. Okay. So this says what? This says sold goods for cash by to Banyana stores at a selling price of 4,900. Okay. Now that's the front picture. That's what they're giving us. That's what they are telling us, right? But yes, there's two accounts affected. The first two accounts that are affected, but there's other two accounts that are affected. So without losing you guys, we sold goods for cash. Remember, cash. Cash. We look at the bank. We start off with the first two. There we go. There's my bank. Bank is an asset. Increases on the debit, decreases on the credit. Right. So it's all goods for cash at a selling price. So we got this money, selling price. That money came to our bank account. Right? The selling price came to our bank account. So it's a plus. Now we have made a debit entry. In the second account, I need to see my credit entry. There we go. But now let's check what was the money for? They sold goods. Can you see? So the money was for me selling goods. So in actual fact, I got an income which is a sale from the sale of goods. Remember dead click? Now sales is an income, increases on credit and decreases on the debit. The equation balances. So when we go to our table here, the first account that is debited is bank, and the account that is credited is sales. It's a plus under my asset for 4,900. It is a plus under owner's equity. Remember, owner's equity is affected by incomes and expenses. Now, in this transaction, when we sold goods and when we sold goods for cash, we actually received an income from the sale of goods. Liabilities was not affected. You get your marks there. Right? And then now, for the second part of this, remember you sold something in order for you to get money. So this first transaction is for the money side. Do you understand? It's for money. You received money, right? We recorded it under bank. For safekeeping, it's under bank. And what the money was for sales, right? But you also exchanged something in order for you to get that money. So the second part is for what has happened for you to get that money. Now, trading stock was affected. Do you understand? Trading stock was affected. So here, the other part of it, this is part one of it. The part two of it is that trading stock was affected. So we will start with saying trading stock. Trading stock is a asset, increases under debit and decreases under credit. Right. So trading stock is affected. But we do not record the selling price of 4,900 on the credit side. No, we do not. We need to know, okay, selling price, all right? We know it is 4,900. We do not know our cost price. They didn't tell us our profit, right? Remember when we did this in class, I said to you guys, you do a table like this, where you associate the amount with the percentages, right? They told us that our markup percentage here is how much? They told us this 40%. Remember this one? It is 40%. So markup is generally a percentage that is associated with the gross profit. There's your markup. And this one is always 100%. Okay? And then your cost, your selling price is 100 plus your 40%, which makes a total percentage of 140. Okay. So in this case, we'll use the unknown over known method in order for us to find the cost price and the gross profit. Oh, no, the cost price, because we need to find out the, you know, the how much did it cost you, or in actual fact, yes, how much was the original price of the stock that you took out? Remember historical cost, right? So when you bought the stock, you bought the stock with in full in 100%. So you recorded that amount under trading stock. So when the stock goes out, it also needs to be recorded at the original price that it was bought for. Do you understand? So in this case, we do not have the element of the to know what was benefited from this amount. The only side where we know what we benefited is from when we are looking at bank and when we are looking at sales. Here we just need to record it at its 100%. So in order for us to find the original price that we sold it for, we need to calculate what we call we need to find out what is the cross price. So here we go. Unknown over known method. It's 4,900 multiplied by. Now look at this. The unknown over known method says you put the unknown on top, what you do not know at the top, and what you know at the bottom. But that's not only it. Now, how this formula works is that, can you see this amount? It is associated with this percentage. Do you understand? So given that I'm using the 4,900, the amount, right? I'm going to multiply with the known part is the 4,000, and the 4,000 is the one that I'm using. So of which at the bottom I'm going to have a denominator of 140. I don't need to put the percentage, just a figure that I need to put on my calculator. What am I looking for is the 100, which is my unknown. Remember, I do not know this amount. And if I put this calculation, I will figure out what is the amount there, right? So it goes like unknown over known, and then it's called the unknown over known method. But it's not simply that. If you use this amount, can you see this line here? I have the amount, I have the percentage, so I can use that. And there's the amount. The percentage that I have of the amount is going to go at the bottom. The percentage of the amount that I do not have is going to go at the top. And of which, when I put this on my calculator, it is going to give me the amount that I'm looking for my cost price. So we said it's 4,900 multiplied by 100 divided by 140. You get the amount of 3,500. That is my cost, boys and girls. That is my cost. And then obviously, if you want to go find out the cost, the profit, it's simply taking the sales minus the cost of sales, and then you get the profit. But in this case, we do not need to know what the profit was, because we are not asked for profit, or in this case, it's not relevant, right? So now I have the original, what I bought it for, so I need to take out the cost price of what I have original bought the stock for. So there we go. We're gonna make a credit entry because we have sold the goods, so the goods have went out. The credit entry, and then for every credit entry there must be a debit entry, right? But now in this case, can you see that yes, the stock went out, right? But which account must I write here? for stock going out, right? So we're gonna write the account cost of sales, right? It just simply says it, right? The cost of which you incurred when you are buying, you will now record when you're selling. I hope that makes sense, right? I won't say it again, but it is like that. So this is an expense. Remember, it has costed you before, right? And then now you're selling, so you need to record it. Remember when you are buying it, then it just came in there, and now you're selling. Now you need to show it. Now this is an expense, right? You're gonna record the debit side. There's an expense, you increase on debit, decrease on credit. So it's like that, right? You can just go look up what is the cost of sales, and then it will tell you, right, in clear fact, what is cost of sales and why we need to record it after selling goods, right? And obviously, cost this cost price is same as cost of sales. You understand? So when you're looking at trading stock, these two are most likely to always be in par, always work hand in hand with each other, right? In order to have a proper recording of the stock going out on your business. Okay, so as you can see, I've credited trading stock, debited cost of sales. So when you come here, you will say what? Account debit is cost of sales. Account credit is trading stock. Right. And then what amount are we going to record here under asset is what? So we do not just record, we see, okay, this is classified as a what? As an asset. So how did it affect my asset negatively? So we'll say negative 3,005. And then what is this? This is an expense. How did it affect my owner's equity? Remember, owner's equity affected my incomes and expenses. Now, we said expenses affect owner's equity negatively. I can see it is a positive way, but we said expenses affect my owner's equity negatively. So you put a negative. Liabilities is not affected. If it was an income, it was going to be a positive. It's just that simple, right? It is just that simple. Don't get confused with this, with the pluses and the minuses. Right. The dead click rule just merely says that expenses are debited, which means they increase on the debit side. So just look at it in this way. At home, right? When you're looking at having groceries at home, it is an expense. But imagine if you wouldn't you would not have groceries at home. You wouldn't survive a month. Do you understand? So you need to have groceries, and of which is an expense to you guys. So we say there's your owner's equity, there's your parents' pocket, right? We're comparing owner's equity with your parents' pockets. So owner's equity is affected negatively by expenses. It affected negatively by groceries. So now you look at this. The groceries, when they come into the house, it's a positive. It's a plus. You are happy. But how did it affect the pocket of the parents? It affected them negatively. So you see it like that. You see owner's equity as the pocket of the parent, and then when they get an income, it's a plus. When they are incurring an expense, it's a minus. But according to the day click, you do not lose the day click. You always record a plus. Remember, you at the end, you become happy when the groceries are there. But how your parents are affected, not in a good state, but it needs to be there for the business to function. So, which is why we have a negative side. I hope I explained that very clearly for you, Waited. And now let's continue with transaction E. Right, so we are done there. Can you see it's nothing scary? We have both. I just missed this. So yeah, we have both. We have now four transactions affected. Now this only happens when there was a sale of what's it called? A sale of goods. But there's also other ones that would actually tell you that four accounts are affected. But you just need to find out. Okay, first, what is the main story and what is the backstory? The main story was that we sold goods, we got the money. The backstory is that we have to record that we do not have the goods anymore in our stock, and you have to record them. You have to subtract them from your books with the original amount that you bought them for. Understand? Okay, get a mark for that, a mark for that, a mark for that, and a mark for that. So we are now looking at transaction E. Right. Now, transaction E says the owner, Majola, took a loan of 50,000 from Tebe Bank at an interest rate of 12% per annum, and it is payable monthly starting from the 30th of April. Right. So now, also this has a backstory, but what is the main story here? Is that we took a loan. Owner took a loan for 50,000 from Tebe Bank at an interest rate. So can you see? When we now read further, it now tells us more information. But now we'll just look at the main story. The main story is that the owner took a loan. Let's find out the two T accounts that are affected from the owner taking a loan. Right? Owner took a loan. Now, when you think of loan, what happened? What happened? Took out a loan. You needed money, so the money did it come in your pocket? Yes, it did. So we have our bank. Bank is an asset. Uses on the debit. Uses on the credit. So the money came into our bank account. Can you see? But now we have made a debit entry, so we need to have a credit entry. Now, where is this money? What was this money for? It was for a loan. Do you understand? It was from a loan. So now a loan is a liability. Can you see? Now we have our second account. This is the main story. This is what we have as a main story. We start with the main story. Now we need to record this too. So the account debited is bank. Account credited is loan. Now, how were my assets affected? Positively, because we got the loan, we got money in our bank in a form of us acquiring a loan. So you say positive 50,000. My owner's equity is not affected because when we are looking at the owner's equity, we are looking at expenses and incomes, so it's a zero. But now we have acquired a loan. Can you see? Yes, we got money in our bank. It's a positive, and we now have incurred a what? We owe someone now. Do you understand? When we owe someone, at the back of our heads, we need to know that, oh gosh, we have a liability that is worth 50,000, right? So we need to record that as a positive. There we go. So everything is done. You get a mark for each entry there. I feel like with this question, you got a mark for each and every entry that you made. Just one mark for each. And then now, what is the backstory here? Because now they further told us more information, and then we need to figure out why they tell us more information. Because now we can't just leave information just hanging. We can't just stop by saying owner Majola took a loan of 50,000 from Tebe Bank, and then we end there. Do you understand? When it continues, it says at an interest of rate of 12% per annum and is payable monthly starting from the 31st of April. Okay. Now, why would they tell us the date? Why would they tell us the interest? Okay, they're saying it's a monthly. Okay. I didn't staple my papers, but okay, let's go back and find out what's about this date, the month. It says the following transactions are for April 2025. Oh, so that's why they were telling us about the month. We are on April. Can you see that? So we are on April, and then when did we take this loan? Right. Remember, these transactions, they would happen in the month of April. In the month of April. Ne? Regardless, maybe it like in the month of April, these took place. So it says at an interest rate and is payable starting. So we are starting to pay this loan on the 31st. We are doing the transactions are for April, so within April. But when April ends, I have an interest to pay to who? To the loan at the bank. Can you see that? So we need to find the interest. So quickly, we're finding the interest of 1 month. Ne? So 50,000 multiplied by 12%. Oh, times also, sorry. 1 month over 12. Because they said per annum. If they said monthly, I was just going to say 50,000 multiplied by 12%. But now they told us that it is per annum. The interest is per annum. So say 50,000 multiplied by 12% multiplied by 1 over 12. And then you will get your interest for the month. So here's my calculator. Just simply say 50,000 multiplied by 12%. Right? I said shift, and then there's a percentage sign there. The open brackets button, and you say times 1, and then I use that button over there to say over 12, and I found out that my interest is 500. And so that's the backstory. So this 500 needs to have a double entry as well, like how the first one had a double entry. So okay, 2 T accounts are affected, and you see 2 T accounts are affected. And now what are they telling us? They're telling us an interest. So we know that the first account is interest. Is it interest income? No, it's an interest expense. And we said expenses affect owner's equity negatively, but expenses are what? Are debited and increase on the debit, decrease on the credit, right? So I have incurred this expense, so I am going to put the 500 there. Do you understand? And then I've made a credit debit entry, so now I'm going for the credit entry because of the double entry principle. Okay? So, but what is this account? This account is what? Let's read. It says an interest rate of 12% per annum. An interest rate of 12% annum, and it is payable monthly. So we need to take out this money every month. Account affected would be bank, because we are taking an amount we need to pay. Remember, with loan you need to pay each and every month. So can you see? Well, generally when expenses are incurred, money goes out. It's simple as that. So we need to record that double entry. So the first account that is affected, account debit is interest, expense, account credited is bank, negative 500 because you need your account was affected negatively for paying, and then negative 500 because it's a expense. Right? Get a mark for that. Right. So here it can be interest on loan also. You are not wrong for that. But we know for a fact that it's an expense. So which is why I just simply said interest expense. But you can say interest on loan. Okay, let's do F. Right, okay. So F says we received 800 from a data. Right? So we have received 800. So that's money. It's coming into our bank account. From the data, B Bambo in settlement of his account of 950. Okay, so this guy was supposed to pay 950, but he gave us 850. Okay, T account for that. We look at this. It's like a blueprint, guys. You need this. But you need to be quick now. You see, because time is moving and you need to know your debit and credits quickly so that you can finish up the question quickly. But remember, there's minutes there for you. Remember, this one I can spend like 35 minutes on it. Right? So if you're way past 35 minutes, you must know that you must quickly finish up so that you can move on to the other questions. Time is available. Time is there. This is that you must use it wisely. Okay, we have received 850. So count debited. Now, what was this money for? It says received 850 from a debtor. Okay, in settlement of the account. So this guy is the one that paid me. So him took money before, so now he's paying. So debtor. Do you understand? Remember, when debtors owe you, the monies that they owe you will increase. When now they're paying you, the money that they owe you will decrease. So this is the double entry for that, right? So we debited bank, we credit debtors, control the amount of, so it will be a positive 850 because now what? Bank is an asset, and then it will be also a negative 850 because debtors control is an asset. Now, no incomes or expenses were affected, so it's a 0 0 there. You see that, right? So I'm just putting the text to encourage you guys to know that if you put an entry correctly, you'll get a mark for it. But it's just extra work that I'm doing. But yeah, okay, fine. So there's more information that they told us here. You have recorded the 800, but there's another account that they've recorded. There's another amount that they've recorded, which is another amount that they've stated, which is 950. They said the debtor settled the account. Settled account. But the account was owing 950, but they paid this much, which means we gave this guy discount. So this is discount allowed. Now, discount allowed is an expense, right? So this guy was supposed to pay 950, but they paid 850. So what was the discount? The discount was 100 rands. So I record under discount allowed an amount of 100 rand, and then we take that to the credit side. Right. Now, remember I said generally when you incur an expense, what's this? Bank will be affected. Yes, some. But in this case, he was supposed to pay 900, and then in my books, I have to state that he actually paid me the full amount, right? But this I have forgone, like I have lost it, right? So here is the debtor. Do you understand? So when I look at this, right, yes, I've written it separately. Can you see? But when I look at this, uh, it's it's simply saying to me that when, because it's the same account. Let's say I wrote it in one place. Can you see that the total will be 950? Can you see? So given that he settled his account, he now knows that no, that guy gave me 100 rand. He said I can pay 850. So the 900 rand, the 100 rand, I can just simply say, well, it's he's fine with it. So in actual fact, my account, the debtor's account, is now closed off. Do you understand? It's now closed off. It doesn't need to be paid anymore. I don't owe that guy anymore. Do you understand? So of which why we are saying, okay, debtor's control is credited by the amount of 100 rand. We are not saying we have bank, because we can't take out money. Come on, we can't say it's bank and we took out money. No, the guy settled the account in full. Do you understand? The first 800 we as a business received. The second 100 rand, the second amount that was mentioned there, that we needed to find out how much was the discount, was the amount that we gave off, or the amount that we said, okay, it's fine, you can take. And then as a business, we have suffered a what? An expense. Can you see? So we'll say what? We'll say account debited is discount. Allowed. Account credited is debtors control. Right. This is an expense. This is an asset. Our assets are affected negatively by 100, and our owner's equity is also affected negatively by the 100 rand, and then it's a zero there. It's as simple as that, people. Do you understand? We cannot say bank here. There's no way we can say bank, because it doesn't make sense, right? Just understand it in this manner that I said. Okay, the last one, and for encouraging you guys, there we have the ticks. There, yes, you've done it, you will do it, and it shall be like that. Okay, I hope I am audible, or unless you need to listen with a full volume on your earphones. Right. So the last transaction says what? Says received a statement from the bank, and it reflected the following. So cash handling fees and service fees. So generally, things that are fees from our bank are generally bank charges, because this is the statement sent from that bank where we are banking from. So you need to add these two. So also things like a levy, it is also a what? Bank charges. So you say 520 plus the 180 will give you 700. Yeah? Now the 700 is the amount that I'm going to record. Now bank charges, yeah? It's bank charges. They've charged you, the bank has charged you. You are keeping money there, but the bank has charged you. Right? So what happened in your bank account? You lost money, the amount of 700. And then bank charges is what? Is an expense. They charge you for keeping your money in the bank. So we have made a credit entry, and then there's a debit entry. Right? So we come here. Which account was debited? Oh, sorry. Which account was debited? It was the bank charges. Bank charges. And the account credited is the bank. The amount of 700. How is my asset affected negatively? Can you see? How is my owner's equity? This is an expense, we said. It's affecting it negatively. And then our liabilities is not affected. And boys and girls, there you have your 14 marks clean, right? So I'm gonna do another video for the second question, right? For the general journal. Right? So learners, you need to do this on your own first, and then wait, you need to okay, so you practice using the video, but also um, what's this? When you're practicing on your own, you mustn't look at the answers and then you say you understand. You must look, you must do like the T accounts and understand why is this debited, why is this credited, so that you can increase the knowledge that you have to better make you understand when you go into the exam. Because when you get there, you guys, you just lose it. I don't know for what good reason, but I'm sure you guys are well aware that it might be daunting in the exams. So you just need to keep on your basics. It's just keep it simple, and be quick when you're doing the T accounts. And then you must understand why you're doing a certain account. If then you find that it becomes difficult for you, just go back and say, is this an asset? Is this a valuable possession of the business? Which is an asset? If it's a no, is this an expense? Is this an income? Right? Is this a liability? So those kind of classifications must come naturally to you, or if they don't come naturally, you must know that which are those accounts that are classified under those classifications. So for now, boys and girls, for the next video, I am going to do question 2 for the general journal. I know some of you said might be difficult, but this is actually the simplest topic ever, because we are just from doing the T accounts. So this is just the continuation, but in a different table. It's a different table, but they're still asking us about account debit, account credit, right? So I feel like this is the simplest. Well, I hope after this lesson it will be the simplest. So let's take a short break and then we'll come back.